I felt like real estate made sense. Once I started reading about it, the tax advantages were huge. I could operate it and kind of figure it out as I went along. I could self-manage. And with my operations background, that made a lot of sense to me. Something that was going to, I think, put off passive income is the way I looked at it then. Of course, that's not really passive because I was managing it and I was doing all the work. The biggest misnomer in real estate ever is that it's passive income. It's only passive income if you are actually investing in someone else's deal and you're not doing any of the work. But if it's your deal and your project, there's nothing passive about it.
Hey guys, welcome back to the show. I got an episode for you that hits really all of my hot button issues: business building and real estate and creating real wealth. Brian Green is an entrepreneur who started out at the age of 22 owning and operating Verizon storefronts, eventually growing his portfolio to as many as 23 Verizon stores before having an exit sale to a larger company. After his exit, Brian discovered real estate. He's now an investor and syndication operator in upstate New York. And we kind of dive into what does syndication 101 look like from the limited partner side. So if you were a high income earning professional and looking to diversify some of your income into passive, truly passive investments by parking money with somebody else, what does that look like? So Brian gives us a good 101 education on what to look for, what those deals look like, and how you can create some diversity of income outside of stocks, bonds, and traditional asset allocation. So I hope you enjoy this episode.
Welcome to Time Freedom for Lawyers, where the goal is to become less busy, make more money, and spend more time doing what you want instead of what you have to. Bringing together guests from all walks of life who are living a life of their own design and sharing actionable tips for how you too can live the life of your dreams. Now, here's your host, Brian Glass.
Hey guys, and welcome back to the show. Today's guest is Brian Green. Brian is the owner and operator of Green Springs Capital Group, a real estate investment company in Saratoga, New York. Comes from a background of owning and operating as many as 23 Verizon retail stores throughout the Northeast. Brian, how are you doing?
Good. Thank you, Brian, for having me on your show.
Yeah, too many Brians on this show already. I want to start with your retail franchise background, Brian. How did you get involved in that?
When I was in college, I took a part-time job working with my brother at a paging store. This is in the late 90s. So we were selling pagers, beepers, whatever you wanted to call them back then, for a reseller here in Albany, New York, who eventually started selling phones when they were early on. Companies, we were selling prepaid phones. We were selling, back then, contracts were extremely expensive, and Sprint was like the number one player in cell phones. So we started doing that. And then as I graduated from college, my brother actually went on to start his own Sprint retail franchise. And I went on to do Verizon, and we had a mentor that owned the paging company who used to be an executive with Verizon, who kind of was our angel investor and also our connection to get us contracts with those two different carriers. So without his support, we never would have been able to get it at such a young age. I mean, I was 22, had no money, and my experience was working in his store for a couple of years. So he definitely was the impetus to get us started.
I'm curious about that. Why did you choose a competitor brand to your brand?
It was just strategic. I mean, our mentor, you can only there was non-competes and so our businesses could not be legally affiliated. So my brother had already taken on Sprint because Sprint was the main player at that point. Everyone had a Sprint phone. And then the next most profitable would have been Verizon. So that I kind of just went down the line. Over time, it ended up being that Verizon was the winner in that game. But in the late 90s, Sprint was in first position.
So in the late 90s, what was the availability of franchise documents and information that lets you compare across brands, which is the good deal and which is maybe the kind of business that you don't want to be?
So these were not technically legal franchises. They call them independent authorized agreements or independent retailer agreements. They kind of wanted a quasi legal structure where they had control, but they weren't beholden to the franchisee. So it kind of gave them the best of both worlds, where they had just enough control to make sure you were doing what they wanted you to do, but not enough where they were legally obligated to take over if things went sideways or they had to back leases or anything like that. So it was definitely a one-sided contract. There was no negotiating rules. You could go through and redline as much as you wanted to, but at the end of the day, the contract was the one that they put in front of you.
As a 22-year-old, what resources, if any, did you have to compare? I want Verizon, I want Sprint, I want Nextel. I don't know what else was available at the time, but I mean, it seems to me today you would probably be able to go to like franchises.com or I just made that up, but something like that to compare, the different terms that you might see in different brands. Was any of that available to you in the late 90s?
Only to the extent that I knew that my brother already had a contract established with Sprint. So I knew what that structure looked like and what the commissions were. But to be honest, it was more about our mentor having a relationship with Verizon. And also from a sales perspective, we knew that was going to be a strong brand that we could sell. All of the carriers were kind of paying the same commission amounts and had generally the same kind of terms and conditions. And I mean, they were changing the contracts on an annual basis. So even if you did your due diligence on the front end, 12 months down the road, they could have gave you a new commission schedule. They completely changed how they were going to pay you for sales. So it kind of would have made the original research moot at that point. So the brand was more important and how effectively we could sell it was more important.
Give me an idea of like the size and scope of your operation. Are you a storefront in a mall? Are you a kiosk? What did you have going on?
Yep. So we had at the biggest point, we were 23 stores and I had 50 to 65 sales reps rotating between those locations. So we were doing a lot of overlap because geographically we had 3 or 4 stores in one location and 3 or 4. And so employees would be shared between stores, but we had mostly strip malls and freestanding locations, no internal kiosks or big malls. We were trying to limit our risk in that way, because any of those leases would have been extremely expensive and long-term. Whereas in the strip malls, we were allowed to get away with 1, 3, sometimes 5-year leases at reasonable costs because the owners were usually local business people and a little bit more reasonable to deal with. And then, we ended up getting up to $10 million in annual revenue in the Verizon stores. And it's a commission model, right? So back then we might buy phones for $500, just to pick an easy number. We turn around and sell it to the customer for $100, which sounds like it makes no sense, right? You're losing $400. But then the carrier, Verizon, would pay you a commission. So they might pay you $600. And so you end up netting $200 on the sale because you're getting the customer, their customer, to re-sign their contract, and they're getting 2 more years of service or whatever the term was. So it was kind of like a weird game where we're inventorying an extremely expensive product, right? So we were talking tens of thousands, hundreds of thousands of dollars in inventory and selling them at a loss to make back the commissions.
Well, I remember that. I remember getting my first cell phone probably in, 2001, 2002. And I think it was either a penny or it was $1. Like it was absurdly cheap. And I remember the salesperson being aggravated with me because I didn't buy, whatever $15 accessory and I think he told me like the markup on these accessories is where we really make our money. And I'm like, the $15 thing, guy. But I remember when these stores had the flexibility to reduce the pricing to almost nothing because the subscription model was really what Verizon was after. But I didn't realize that you as the retailer were paying $100 or $200 upfront to acquire that phone.
Yeah. That's correct. And then to further complicate that, if the customer cancels their contract, at least back then, within the first 6 months or whatever, there was a chargeback period where Verizon would charge back your commission. So if a customer took your phone for that $100 and you gave them the $400 subsidy, and then they end up canceling it 3 months from now, well, I'm out the $400 in a big way, and Verizon just takes back their commission. So it was kind of a no risk situation for the carrier, and all the risk was put on the independent operators like ourselves.
Now I'm thinking about the old credit card swipe where it wasn't the machine where it would dial up and then find out, was it declined or not? It would take the imprint of the card. And so how often were you having to deal with people that would show up at the store and buy something and then be like a phantom person who never paid their bill, and then you were eating the chargebacks?
It did happen, not as frequently as you would imagine. I mean, if they signed up for the phone, they're giving social security number, date of birth. It's gonna hit their credit for sure if they do that. But there were times people did that, or they had stolen information or whatever. They pretended to be somebody else. It was infrequent though. Most of the customers that ended up canceling were just dissatisfied with service or billing or something like that, which again is was not within our control, right? So we're taking a loss because of a mistake that the carrier made. But overall, you can imagine based on volume, more people kept the phones than did not. So it was a profitable endeavor in the end.
As you all were scaling from one store to 23 in this quasi-franchise model, was Verizon outfitting you with sales scripts and financial modeling or anything, or did you have to figure all this stuff out on your own?
On our own, pretty much. Yeah. So we were independent, right? Still, even though we had a contract with them. So we were deciding how much we're going to pay our staff and what hours they're going to work and what accessories we were going to carry, to your point, how much we were going to charge for those. We set our pricing on everything and decided what inventory we were going to carry. Now, the carrier did have rules, as they were very particular about using their logo and signage, and they tried to get as much detail as they could into how the internal parts of the store were set up. But they were really just offering you opinions on that. They couldn't force you to do it because there wasn't a true franchisee model like they would do in like a McDonald's or a Dunkin' Donuts. And then they gave us a marginal amount to open stores. They gave us some sort of startup money whenever we expanded, but most of it was being paid for by us.
And what was your process of learning from your mentor? And I think you called him an angel investor. Like, you're 22, right? Opening these retail stores where you're selling a product that cost you more to acquire than you're selling it for, and then hoping that the money shows up from Verizon. And so that, to me, is like, it's a big leap of faith, and you must have had some good training or some education coming from the mentor. So what did that structure look like?
Yeah, so he was, and I think he would admit to this, he was very good at sales, less so on the operations side. So the operations part is the kind of part I had to figure out a large part on my own, and with the help of my brother, who was doing the same thing with his Sprint locations. So it was kind of just normal because that was the business it was. It was just, this is how it works. You pay this much for the phone, you sell it this, and you get a commission. I'm like, okay, that makes sense. But he was more big picture marketing, sales, and, just drive sales as fast as possible.
Were there things that you found out later were not normal? So I call this like beginner's ignorance, right? Where, you're going through and everything seems perfectly fine for you because you have no idea that you're not supposed to be doing any of this the way that you're doing it, right? So for me, it's like the first time that I ran a marathon, my whole training went really well, and I did everything absolutely incorrect. Did you have anything that, like, on the back end or looking back now, you recognize we were doing that completely different than everybody else, and it either worked really well for you or it wasn't working at all?
I mean, not really. There was some stuff, as it pertains early on to like, return policies and different ways that we would interact with customers. I think we almost took it for granted because at that point it was like the big boom for cell phones, right? And then the iPhone came out, and everyone, that you had a product that was in huge demand, right? So whether it was right or not, you were able to kind of, back then, stores would charge like restocking fees, and they'd have like no return policies. So we kind of fell into that trap also because that's what everyone else was doing. And then over time, we kind of figured out that this is not the right way to operate. This is not the right way to get long-term business from customers. So we adapted over time and kind of made it a little bit more customer friendly while still kind of protecting our bottom line. But I feel like some of the stuff early on, that stuff that we looked back on, we're like, we probably shouldn't have done it that way. There was probably a better way to do it, but I didn't know any better. That was what I was, but that's how we always did it. So we kind of had to figure it out as we went along.
And I'll pivot away from this in a minute, but I'm always so fascinated by these origin stories and how guys, learn to build businesses without a formal training in building business. But the management and the hiring and the quality assurance across 50 or 60 employees who were going to 23 different locations. Like, it's not even as though everybody's showing up and you can have a daily huddle in the office and then everybody goes and executes. So what did that process look like, and what kind of systems did you have in place to make sure that everybody was doing the same thing and running your scripts and not kind of operating the Wild West Verizon store?
So at first, it's a lot of trial and error. This works, this doesn't work. Let's get rid of this. Let's focus on this. Over time, I got to the point where we had regional managers that were kind of doing a lot of the training and actually some of the interviewing, and they would be on top of quality control, checking inventories and stuff like that in the stores. But to be honest, one of the biggest benefits or bonuses when I sold the company was that, hey, listen, like now it's just like I can breathe. Like I don't need to worry about, 50 different people telling me that they're casually sick on Saturday morning and they can't come into the store. And now we got to cover. And, there was so many moving parts. and you deal with personalities and there's a lot of turnover. These are all, everyone working in your stores are in their 20s basically. So there's no easy answer, I don't think. It's kind of like you just do the best you can as you move along and you kind of learn as you go. But it was challenging at times. And then at other times, everything went smoothly. So it's kind of like a roller coaster.
How many years were you involved with this, from the first store through the sale of the last batch?
I think it was 11 years. It was 10 plus years. Yeah. I ended up selling them at the end of 2014.
And then, so in years like 8, 9, and 10, what was your weekly involvement in the operation of the stores?
So my office was in the back of one of the stores. So I was in our main office all the time. I'd still travel around to the locations a couple days a week. So I was driving through Vermont, Western Mass, down in the Catskills and doing site visits. So it was hands-on the entire time. It did get to a point, I feel like, I know a lot of people talk about the 10,000 hour rule. I felt like towards the end, I knew everything. Like there was nothing in that business that I did not know. I knew how much everything cost. I knew where everything was. And I kind of hit that sweet spot where like, all right, now I can start really crushing this. And, it was just the right time when we hit it. And then we had an offer from a large company from the West Coast, and it was just the right time, right place, and the right number.
And then how long did it take you after the sale of that business to get bored and decide you needed to do something else? Or was there a period of time where you were sort of basking in the afterglow? So
the company was sold in November, like a week before Thanksgiving, 2014. So I kind of rode it through the holidays and was trying to figure out my daily schedule. Didn't really know what I was doing. And then by the time I hit January, I was like, okay, well, now it's winter. It's the Northeast. I don't really have anything going on right now. So I got a little stir crazy. So I start reading books and I started getting into it. And by March, I bought my first small multifamily property. So maybe it was 3 or 4 months of trying to figure out what I wanted to do next. I knew that I was not going to go get a job. I hadn't worked for somebody since I was maybe 20, 21 years old. So, I had gone back to school and got my MBA. So I easily could have went out and got a job with my background, but that's just not the way I was going to do it. I don't like somebody else controlling my schedule, and I like to retain everything that I'm putting forth in effort. So I knew I was going to create some new business. I just didn't know what it was, but real estate started to make sense, and that's where we went.
Were there other businesses that you considered and then decided weren't for you?
There really wasn't. I looked briefly at like other franchise models, like just cursory, nothing in great detail. I felt like real estate made sense. Once I started reading about it, it was one of the first things I kind of gravitated to after the sale. The tax advantages were huge. I could operate it and kind of figure it out as I went along. I could self-manage. And with my operations background, that made a lot of sense to me. So for whatever reason, I was just drawn to it. And it seemed like a good way to reinvest the capital I got from the sale of the company into something that was going to, I think, put off passive income is the way I looked at it then. Of course, that's not really passive because I was managing it and I was doing all the work. The biggest misnomer in real estate ever is that it's passive income. It's only passive income if you are actually investing in someone else's deal and you're not doing any of the work. But if it's your deal and your project, there's nothing passive about it.
Yeah, and we'll come back to that because I know that you are now operating in an industry where you're accepting other people's money and you will go and manage the deal for them. But I'm curious, the property that you purchased in 2015, that first multifamily, do you still own that? You still operate that one, or has that one sold?
I just sold it last year in September.
Okay.
Yep.
Okay.
So, and it was bought in the wrong way. I bought it with all cash, didn't finance it, started doing work on it myself, which I have no business doing. But in the end, it just worked. Sometimes in real estate, time is your best friend. So, I think I bought it for $220,000 in 2015. And then last year I sold it for $355,000, I think, plus all the cash flow that I had accrued over the years. So it just works. Like if you buy a good piece of property and hold it for a decent amount of time, usually it works out in your favor.
And in the early days, so you bought that first deal in 15. Did you buy more that year? Have you scaled up since then? Is it a snowball? What does that kind of look like for you?
Yep. So in the immediate, maybe in the first 3 years up until 2018, I was buying smaller multifamily properties. I want to say I bought up to 6 of them, and they were all between 4 and 6 units. And I was doing largely the same thing, although over time I kind of figured out what I should be buying and how to do this. I think by the time I got to my third property, it basically turned into huge value add or redevelopment of the property. where I knew that like the numbers are going to look way better if I can buy something that's distressed, fix it up, refinance it out, pulling out most of my capital or all of it. And then it's basically infinite returns at that point with a brand new building that has almost zero repair and maintenance costs. So that's where I went after I kind of figured out on the first couple that that's what I should be doing. And now that has snowballed from there. In 2018, my brother came on and partnered with me. And from there, we've quadrupled the size of our portfolio. So now we have over 100 units, largely doing the same model, but on maybe medium-sized buildings at this point, 20 units and more, where we're going in and redeveloping them and then refinancing at stabilized value and then managing them for a long term.
So I hear a lot of people talking about how bigger is not any harder, it's just bigger. Has that been your experience when it comes to the size of the unit?
Absolutely. I think in a lot of cases, doing a 4-unit building is more work than a 20-unit. Because in most cases, the 20 unit was originally built as an apartment building, right? So all the units are nearly identical. So you're just doing the same thing 20 times in a row. Or if you get into some of these smaller multifamilies, generally they weren't originally constructed that way. So, they're all chopped up inside and you have to kind of piece things together, and the electrical is running this way and that way, and the plumbing is the same thing. So every unit is different. The floor plans are all different. So it makes it extremely challenging when you're trying to renovate, when everything is not orderly. So if you're buying that 20 unit, you can just go through them and it's much easier, and the dollar figures are much better.
And so you and your brother are also doing ground up development now?
That's right. So we have a project right now that's under contract. We're expected to close on it when we get approvals from the city over the summer. And that'll be construction of 42 units. 6 of them are going to be condo conversions that are within the existing structures that are on the property, and 36 of them will be new market rate apartments.
Is this your first ground up deal?
This is the first where, it's actually coming out of the ground. But keep in mind, the other buildings we've done are redevelopment, I call them. They put that in quotation marks. But our redevelopment is basically going in and rebuilding everything at the property. So the only thing we really have kept is the slab and the framing and some of the drywall.
Right.
Everything else has been brand new. So this actually coming out of the ground with blueprints and clean and not worrying about anything existing should actually be much easier than going into an old building and trying to make it new. But this will be our first foray into ground up.
Yeah. And so let's just talk about, and I know that you told me this is a 506B offering, which means we got to be a little bit careful about details with regard to this deal, but just like a syndication structure in general. So in general, this is folks that have high W-2 income for whom, real estate is attractive, but it's not a good use of my next hour or dollar to go out and buy a duplex or a quad for myself, because my time is best spent building my primary business. But my money is probably better spent, on a real estate deal and creating a stream of income that's going to take care of me long before I hit, 65 or 70 retirement age and be able to tap my 401k. And so can you kind of walk us through the 101 of what a syndication opportunity might look like for somebody who's got a W-2 job and who is interested in investing in real estate, but is not interested in spending any time doing the things that you just talked about with blueprints and plumbing and electrical?
Yeah, sure. I can talk. Well, there's lots of different ways to do it. So every syndication is going to be structured a little bit differently. I can tell you generically speaking how we plan and are structuring ours. So we'll do something where we are bringing on investor capital from passive partners, and then we're basically doing all the work. We're providing the management services. We are turning an old building into a new building and leasing it out and getting it stabilized, the financing, everything that goes into it. And then when we're done, the objective is to refinance the property. And in this new development, many times you can give the investors all of their money back, and then they still retain ownership in the property long term, where they'll get quarterly distributions and some profit at the end when you sell the building at some point in the future. And other times it might not be a full return of capital, but that's generally our objective, is to give a full return of capital back to their investors to put them in an infinite return position where they have no risk in the deal, and then they can stay in it long term with us. Because for us, our company, we're interested in doing development for long-term wealth. We don't want to have to sell the property. And I know that a lot of syndications are built entirely upon the fact that you have to sell the property. To us, that doesn't make a whole lot of sense. If we're going to put all the time and effort into making this building right and getting the right tenants in there, we want to hold that for as long as possible, because we know the longer we hold it, the greater the value will be. And that's where the real wealth is created. I feel like many times syndications turn into almost an apartment flipping business.
Right.
Where you have to sell it in 3 or 5 years, or else you can't give some big shiny IRR number on a piece of paper. That I'm not really interested in. So if, the IRR is great in theory, but I would much rather give somebody my money, know that I'm going to get it back, and then still get quarterly checks in perpetuity. And then 10 years from now, 15 years from now, if we do decide the building and you get a giant check because of profit distribution, well, then you just got your profit. But I don't want to tell an investor going into it that, yeah, hey, we're going to sell it in 5 years, because maybe it makes sense to keep it for 15. I don't know what that is right now. You're just guessing if you're 15 years into the future.
Well, and I'll tell you, every single syndication deal that I've been involved in, and almost everyone that I've seen, has been exactly the structure that you described as not wanting to do. Is we get into it with a 5-year hold with maybe 2 optional 1-year periods, all at the option of the syndicator, right? So as a limited partner in one of these deals, you have no control over when you're going to get your money back. It's going to come back when it's the right time for the expert. And that makes sense, right? Where you're deferring to the expert to make the decision about the sale. But there are very few that are out there that are doing what you're talking about, which is, we're going to get into this thing, we're going to create it, then we're going to refinance and give the investors all their money back. And then just as with a BRRRR strategy in a single family or a duplex, you're going to retain the cash flow going forward, and you're going to have all your money back, and you can go put it towards the next deal, either with your company or with somebody else. And so good for you. I think that's a smarter way to think about it, especially if you're somebody who's out there trying to build up the snowball of passive income streams, because one of the issues that you have if you do syndicated investments is you don't know when the money is coming back. And when it does come back, you often have a limited amount of time to then redeploy it without taking a big capital gain tax hit at the end of the year, right? So on that note, Brian, you want to hit a couple of the tax benefits of coming in as an LP to one of these deals?
Yeah. So to the point of what you just said, if we don't have a time horizon for a sale of the property, there is no taxable event at the end, which, yes, it's nice to get a big check for $100,000 or $200,000, but if you're somebody that's an attorney or a doctor and you're paying a ton of taxes, you probably don't want to pay another $50,000 in tax on that proceed, right? So if you don't sell the building, there is no taxable event. Ultimately there's going to be at some point, but our strategy is more focused on refinancing periodically every 4 to 5 years or something like that. And then when you get a refinance event, each of the passive owners would still get distributions, but those would not be taxable. So it's kind of getting the best of both worlds, where your wealth accumulates over time without paying the tax, and you still get to realize the profit distributions when we refinance. And then to the quarterly distributions, which would be paid out as well, those are going to go to passive owners and the general partners like ourselves, pro rata, depending on how much ownership they have in the building. And a lot of times those cash distributions are also limited in how much tax you need to pay, because we have depreciation on the building. So we do cost segregation studies, which is just a fancy way of saying we allocate the building into tiers of how long different parts of the building are going to phase out, for lack of a better term, which allows, in most cases, cash distributions to be tax neutral, because you'll have just as much in losses, if not more, than you would from actual distributions. This is obviously, I'm not an accountant.
Right.
I'm a business guy. So check with your accountant. Everyone's situation is different. If you're a real estate investor, it's even better for you. But if you're, somebody with a job, attorney, doctor, what have you, there are advantages to being in real estate that are not available in any other investment.
Yeah, the tax rules for real estate are stupid advantageous to the real estate professional. And again, neither Brian nor I are giving tax advice, and your mileage may vary. But if you listen to the last 5 minutes and you understood like a third of it, I would encourage you to go back, listen to it again, and start to figure out, these things like depreciation and cost segregation, and get familiar with those terms, because that really is a way to have money coming in every month or every quarter from your investments that is not hit with a tax bill of a 15% capital gain, or at your ordinary income rate, like all of our money that we earn in our practice as doctors or as lawyers is. And then figure out how to structure your life in a way where you have money that's coming in that's not taxed at that very high ordinary income rate.
That's absolutely correct. And most real estate people, they pay little to no tax, which is kind of why not a huge fan, but that's kind of why Trump got himself in trouble saying that. He wasn't lying. He wasn't cheating. It was just, that's the tax law. Like, he owns a bunch of real estate. He probably has millions of dollars in depreciation. So he shows no income. And that's the rules that are written. So a real estate guy like me would say that those rules are written because the government realizes they need housing. They also realize they're not very good at providing it themselves. So they need to have these tax advantages to people like myself and obviously larger developers to go out and build housing. So the one way to do that is to use the tax code to work in their favor and incentivize them even further to do so.
And to be fair, you're paying taxes in the form of property taxes as you're going along. But, you know, in almost every deal, that's just being passed off to the end consumer as part of the rent. Brian, I'm curious about this because I look around at a number of our friends in GoBundance and many of them are paying very, very little tax. And I'm curious if that's not just a reflection of where you and I are in the life cycle of purchasing these deals, because it seems to me you can get more accelerated depreciation every year by buying another deal, and that'll offset more and more of your gain that's coming in every month or every quarter, more of the distributions. But there comes a time where you get to the end of the life cycle and you aren't buying anymore. You're just managing. And then, of course, if and when you die, your heirs get the properties all at a stepped up basis and they don't have to pay capital gains on it. But I mean, do you suspect that there will come a time in the life cycle of the real estate investor where you do have these maybe unanticipated, because you haven't planned for them very well, tax hits coming in because as you stop buying, you stop capturing as much depreciation?
Yeah, that could happen. I guess it just depends on what your timeline looks like and how you're going to treat, I guess, your investment time horizon. For me, yes, it's advantageous for us to keep buying properties because every time we buy a property, we get more depreciation and it wipes out income that we're earning on previous properties that we've purchased. So when you get to a point where you want to start selling, yes, tax bills could come due. You also have the option to do 1031 exchanges. So for instance, if we do this for 10 or 20 years and we decide, my brother and I, that we don't want to actively be involved anymore, we could sell off our entire portfolio and then strategically do 1031 exchanges into more passive investments. So, you can go out and buy pharmacies or strip malls or something else, or other person's multifamily deals. And then you're just rolling your gains from one property into the other. It is kind of like a revolving mouse wheel, but where if you keep doing that for long enough, you never have to pay the tax bill. And then, as you say, at some point when I pass away, our children would inherit all the property and they would still not pay taxes because you get a stepped up gain. It just depends on if you want to do that forever or if you want to just say at some point, I have enough and I'm fine paying some tax. And there's different ways to do it, and it's different for everyone.
Do you have, again, for people who listen to that last 5-10 minutes and it just went straight over their head, do you have a book or a YouTube video or a podcast where you would refer people to for continued 101, 102 education?
I've read pretty much every real estate book that's out there. So it's hard to kind of narrow it down. I think there's a lot of good ones. I mean, if the Bigger Pockets line of books are all really good and very simply written, so they're easy to understand. There's tax advantages for real estate investors. I want to say who writes that book? It's part of like Kiyosaki's book line. There's a real good one in there though. I can't remember the author. But if you just look up Rich Dad, Poor Dad and tax advantages, the book will populate. But it'll get into all the kind of ins and outs of what 1031s look like and depreciation and all those structures.
It's everybody's favorite book is Rich Dad, Poor Dad.
And it's not even a real estate. It's not even a real estate book. It's just like a mindset book, I guess. You either read it and you put it down and you go back to work, or you read it and you go out and you start buying property.
Yeah. So when I was in law school, I read that and I read Tim Ferriss's 4-Hour Work Week, but I didn't have the supporting structure people-wise around me. And so, I read that and then I said, this is all bullshit. And I put it down and I never came back to it for 10, 15 years. But because what they're talking about is really a culture shift in the way that we think about our time and our money. And if you read those books, but you don't have the world of podcasts that we have now and the connections that we can make now, like it can be easy to go, that guy doesn't know what he's talking about. Like, how can I be a lawyer and work 4 hours a week if you think about that book title literally? But a lot of things that he talked about, Tim Ferriss, have come true in terms of outsourcing everything to VAs. And there's plenty of businesses that have now been built around, offshoring your intake or offshoring your medical records in my field, your medical records requests or your demand package writing. And like everything that used to be done in-house can now be sent somewhere overseas, and you can work from home or from your island or wherever with this army of virtual assistants. The one book that I would recommend to people who are starting to look at syndications for the first time is Brian Burke's Hands-Off Investor, which talks about the number of different syndicated deal structures, kind of what to look for, what to avoid. And I think, I can't remember if I got this as part of a package or if it's in the book, but there's a whole list of 75 questions to ask any syndicator that you're considering giving your hard-earned money to make sure that they're going to protect it. So yeah, I would commend Brian Burke's Hands-Off Investor to anybody who's listening to this and wants to learn more about how to vet syndications and where to put your money.
Completely agree. I just read that maybe 30 days ago.
Oh, good. Yeah. Now you have the cheat sheet of all the questions that you're going to get.
Yeah, that's right. Yeah. Uh-huh.
So Brian, with that background, and after they've read Hands-Off Investor and they come looking at your deal, what makes your deal different or unique or special where people should invest their time and their money with you?
We talked already about the time horizon. So I think the time horizon is unique in the fact that we don't have a predetermined sale date, which has all the advantages we've already discussed. Also, we are the property manager. So many times in syndications, the sponsors or the general partners are going to hire a third-party company to manage the asset, the property. So they only have partial control. They can only do as well as the property manager is doing for them. So in our world, we are the property manager. So our team will be managing it on a day-to-day basis, the leasing, the maintenance, everything that has to do with that property. So we have complete control over it. So in that way, I think we can execute at a higher level than most others can when they're not doing it themselves. And then lastly, it's our home market. So we're not buying in some other state across the country. This property that we're doing now and most of the other ones we own, they're all within an hour of our house, sometimes 5 minutes from where our team lives. So we have an intimate knowledge of the market. We know everything that's going on in the property, around the property, in the municipality. We know laws that are changing, tenant regulations. There is nothing that we don't know about our and the way that our properties are operating, which I think puts us in a unique position because most syndicators or general partners are buying out of state and they're using third-party management, and they're also, they're selling it in, like you said before, the 5 to 7 year time frame. So I guess in those three ways, we're exactly opposite from all of them.
And what I think is smart about that is that, many syndicators are running to Texas and Florida and other parts of the Sun Belt, right? Sort of skating to where the puck is going to be, but it's not as though everybody is leaving Saratoga, New York, right? So still need housing up there. And why not have somebody who's intimately familiar with that area and who's been investing in that area for almost a decade, run and manage the deal. So good for you for staying nearby and not like just looking at charts and demographics and where people are moving to and deciding, well, we're going to go figure out how to operate, in the Sun Belt. Like, I think it's really smart to be sticking with the opportunities and with the demographics that you are already very familiar with.
Yeah, I agree. I feel like it's, when you're chasing the demographics, that does make a lot of sense in a lot of different ways, but it's also everyone else is doing the same thing. So like everyone else is going to look at the same deals you're looking at. Everyone else is going to look at the same market you're looking at. So it's almost like a race to the bottom, right? Because at that point, you've got 10, 20 different offers on every property. And the winner is one of the guys that offers one of the most amounts, right? So you're overpaying in a lot of cases for properties, and that reduces your margins all around. So I'd rather buy in our home market, which is still growing, and have that intimate knowledge that you talked about that gives us the advantage.
Well, Brian, thank you very much for your time today. Where can people find out more about you and your company?
So they can check us out online, greenspringscapitalgroup.com. We're on Instagram as well at Greensprings Capital. And they can reach out to me personally if they'd like. It's Brian at Greensprings Capital Group. And I'd be happy to talk real estate or investing with any of your listeners that have an interest.
Cool. I'll make sure that we link to all that stuff in the show description. Brian, thanks again, man.
All right. Thank you.